Why would Goldman Sachs be connected to $847 billion of U.S. bond selling? Unless somebody thinks the safe asset is about to get a whole lot less safe. All right, let us talk about the headline that sounds like a plot twist in a finance movie. Goldman Sachs just sold $847 billion in U.S. bonds. And if your brain immediately went, wait, isn't that basically the entire GDP of a medium-sized country? Same. So today we're doing three things, fast and clearly. Number one, what that number actually means in the real world, because headlines love being dramatic. Number two, why big money has been repositioning in bonds, and what kind of collapse they might be hedging against. Number three, what you should do about it if you're a normal person with bills, a 401k, and a group chat that keeps saying, recession confirmed, not financial advice. This is education. But it might be the most important bond market breakdown you've heard all year. $847 billion sounds like Goldman hit sell all. Did they? First, let's diffuse the panic while keeping the seriousness. When you hear Goldman Sachs sold $847 billion in U.S. bonds, your brain imagines Goldman is one dude in a hoodie pressing a button labeled Dump Treasuries, and the market explodes. But in reality, there are two very different meanings this headline can hide. Here are the two versions. Listen closely. Version 1. Goldman sold bonds from its own investments. That would mean Goldman had a giant pile of treasuries and decided, nah, we're out. That's a directional bet. Version 2. Goldman facilitated $847 billion of bond selling, meaning Goldman acted as a dealer. It's a market maker, a broker helping clients buy and sell. That's flow. That's plumbing. It doesn't necessarily mean Goldman is personally going risk off, though the flow itself can still reveal what big clients are doing. And this is why finance headlines are so spicy. They all say Goldman sold when it might mean Goldman processed a ton of selling activity. So the smarter question isn't, did Goldman panic? The smarter question is, why is there so much bond selling happening that a number like $847 billion even shows up in the conversation? Because whether it's Goldman's book or Goldman's clients, the signal is the same. The bond market is under stress, and big money is repositioning. Now, to understand what they're preparing for, you need to understand one thing about bonds that most people never get taught. A bond is basically a deal that says, I'll loan you money now, and you'll pay me back later, plus interest. So why would anyone sell that? Because the moment interest rates move, the value of that deal changes. Let's do a simple example. If you bought a bond paying 2% interest, and then suddenly new bonds start paying 5%. Your 2% bond is now the financial equivalent of showing up to a party with an iPhone 6 and telling everyone it still works fine. It's not worthless, but it's not hot. So to compete with new higher yield bonds, your old low yield bond has to drop in price. That's the first big concept today, and I want you to remember it like a tattoo. When rates go up, bond prices go down. So if Wall Street thinks rates stay high, or go higher, or even just stay volatile, they may want less exposure to long-term bonds, more cash-like assets, more hedges, more flexibility. Which leads to the next question. Why would rates stay high? What collapse are they hedging? Let's zoom out. The real problem. IT's not. Bonds are bad. IT's the system is repricing. Here's the thing. People call us Treasuries risk-free, and in one narrow sense that's true. The U.S. government can always print dollars to pay you back. But that doesn't mean Treasuries are risk-free for you as an investor. There are three major risks that matter right now, and they're the exact three that make big firms nervous. Risk number one, duration risk. Duration is a fancy word for how hard does this bond get wrecked when interest rates move? Longer-term bonds get hit way harder when yields rise. That's why 10-year and 30-year Treasuries can swing like tech stocks when rates are volatile. Risk number two, inflation risk. If inflation is 4% and your bond yields 3%, you're losing purchasing power in real life. You might get paid in dollars, but your dollars buy less stuff. That's like winning a game where the prize is a gift card that shrinks every month. Risk number three, liquidity and forced selling risk. Sometimes bonds sell off not because they're bad, but because someone has to raise cash. Banks, hedge funds, pension funds, if they face margin calls or withdrawals, they sell what they can sell. and treasuries are extremely sellable. Ironically, the most liquid stuff becomes the first thing dumped in a cash scramble.
Ow.
Now let's connect this to the bigger picture. We're living in an era where the US government is issuing a ton of debt. At the same time, the Federal Reserve is not doing the old print money and buy bonds routine like it did in peak QE years. So you have more supply of treasuries hitting the market and less guaranteed demand from the Fed. That means prices have to adjust. Yields rise to attract buyers. Here's where it gets spicy. Higher yields don't just matter for bonds. They're like gravity for the entire financial system. Because treasuries are the baseline. Mortgages, car loans, credit cards, corporate debt, everything references that risk-free level plus a spread. So when treasury yields rise, it can tighten financial conditions across the board. And tighter financial conditions can break stuff. Let me say it in the simplest way possible. When money gets more expensive, weak business models die first. Now, what could Goldman and other giants be preparing for? Not necessarily the end of America. Relax. Usually it's one of these four collapses. And I'm going to rank them from most likely to most dramatic. Collapse scenario number 1. A leverage unwind. Translation: too many investors and funds made trades assuming rates would fall, and they were wrong. So they unwind positions fast. Collapse scenario number 2. A refinancing wall. Translation: companies and commercial real estate owners who borrowed cheap money years ago now have to refinance at much higher rates, and some can't. Collapse scenario number 3. A liquidity event. Translation: something snaps. Could be a bank, could be a fund, could be a foreign shock, and suddenly everyone wants cash at the same time. Collapse scenario number 4. A confidence shock in fiscal management. Translation: investors start demanding a higher risk premium because of deficits, political chaos, debt ceiling drama, or downgrade type narratives. Now, I'm not saying all four happen, but if you're a large institution, you don't need certainty to hedge. You just need risk to be and right now, the bond market is basically screaming non-zero. Here's the part that people miss. Bond sell-offs are not just a bond story. They can be an everything story. Because bonds are used as collateral. They're used in repo markets. They sit in bank balance sheets. They're the backbone of what's considered safe. So when bond prices swing aggressively, the plumbing gets stressed. And when plumbing gets stressed, finance brothers start using words like contagion, which is never a chill moment. So now we have to ask, if the bond market is repricing, what does Goldman actually do about it? Let's talk strategy. What Goldman is really doing. Risk management, not doomsday. Here's what big banks like Goldman Sachs are obsessed with. Not being right. Being alive. Retail investors are like, I'm bullish or I'm bearish. Big institutions are like, I would like to not die in a tail event. Thanks. So when you see massive bond selling activity around a firm like Goldman, think in terms of positioning, inventory, client flow, and hedging. Let's break down the most common reasons in plain English. Reason number 1. They don't want long duration exposure. If you think rates can stay higher for longer, the worst place to be is locked into low yields for 10 to 30 years. So you shorten duration. More T-bill style exposure, less long bond exposure. This is not America's collapsing. This is, I don't want my portfolio to get punched every time CPI drops. Reason number 2. They want optionality. Optionality means flexibility. Cash and near-cash instruments give you the power to buy opportunities when things break. In a sell-off, the people with liquidity become the people with leverage without borrowing. Reason number 3. They're hedging volatility. When rates are volatile, bond volatility rises, and that spills into stocks and credit. Banks hedge with futures, swaps, options, basically financial seatbelts. And here's a key point. If Goldman is facilitating tons of selling, that might be a sign that clients' asset managers' pensions, foreign holders are repositioning fast. That matters because big holders moving in the same direction creates momentum. Reason number 4. Regulatory and balance sheet constraints. Banks can't just hold unlimited inventory. They have capital requirements. So when markets get choppy, dealers can pull back, reducing liquidity, which can exaggerate moves. Translation: when everyone needs the dealer is like, yeah, about that. Reason number 5. The carry trade isn't as free as it used to be. For a long time, people could borrow cheap and buy higher-yielding assets. When rates jump and volatility jumps, that trade gets messy. Funding costs rise. The trade stops being cute. Now, let's talk about the collapse angle in a way that's actually useful. When institutions sell bonds, they're often preparing for one of these three macro paths. Path 1. Rates stay high. Growth slows. That's the grind scenario. No dramatic crash, but lots of pain in rate-sensitive areas. Housing, startups, commercial real estate. Path 2. Recession hits, and suddenly rates fall, but credit blows out first. This is the everything breaks before the Fed saves it scenario. In that world, long treasuries might eventually rally, but not before liquidity stress hits risk assets. Path 3. Inflation reaccelerates and rates go higher again. This is the second wave fear. In that world, long bonds can get destroyed, and the market starts pricing a different regime. Goldman doesn't need to pick perfectly. They position so they don't get trapped. And this is where I'm going to say something that sounds cynical but is basically the truth. Big banks don't predict. They prepare. Which brings us to the part of history that almost nobody talks about, but it rhymes hard with today. The surprising historical connection, the 1994. Bond Massacre, and why IT matters. Now time for a quick story that sounds like ancient history, but it's basically a prequel to today's anxiety. In 1994, the Federal Reserve started raising interest rates after a period of calm, and a lot of investors were positioned for, basically nothing to happen. Rates weren't supposed to move that much. Volatility wasn't supposed to spike. Bonds were supposed to be the boring corner of the portfolio, and then boom. Bond prices fell hard, so hard that this era got a nickname, the Bond Massacre. And here's what made it nasty. It wasn't just that bonds lost money. It was that the bond market's move caused forced selling, leverage problems, and blow-ups in places people didn't expect. One famous casualty was Orange County, California. Yes, son, entire county. They had taken leveraged positions tied to interest rates. When rates rose, the strategy imploded. Bankruptcy. Chaos. Now, I'm not saying we're replaying 1994 exactly, but the rhyme is this. When rates shift regime, the damage doesn't stay contained to bond people. It spreads because bonds are the foundation. And today we've had one of the fastest rate hiking cycles in modern history. So even if you personally don't own bonds directly, you're still exposed through your mortgage rate, your credit card, April, your employer's borrowing costs, your rent, because landlords refinance to your 401k, because stocks get valued relative to rates your city and state budgets, because muni financing changes your job market, because hiring slows when capital is expensive. So when you see a headline like $847 billion in bond selling, the right reaction isn't blind fear. It's curiosity. It's what part of the system is most sensitive to higher rates and bond volatility. And is that part already cracking? Which takes us to the real question everyone cares about. What could actually collapse from here? Let us talk about the pressure points where the bond market can turn into a broader financial problem. The real pressure points, where bond stress turns into a broader collapse. Let's map the areas that are most vulnerable when bond yields rise and stay elevated. I'm going to give you 5 pressure points, and I want you to listen for which ones show up in your own life. Pressure point number 1, commercial real estate, not your cute apartment lease. I'm talking office buildings, big retail properties, and large multifamily deals bought with cheap debt years ago. A lot of these deals assumed low rates forever. Now refinancing can mean going from this works to this docent pencil overnight. If enough owners can't refinance, you get distressed sales. If you get distressed sales, you get write-downs. If you get write-downs, lenders get hit. And that leads to pressure point number 2, regional banks and balance sheets. Banks hold long-duration assets. When rates rise fast, those assets drop in market value. Even if the bank says, we won't sell, so it's fine, markets can still panic if depositors leave and the bank has to raise cash. That dynamic has set values down. Deposits unstable can create sudden crises. Pressure point number 3, corporate debt and the refinancing wall. Many companies locked in low rates years ago, but debt matures. And when it matures, it has to be refinanced at today's rates. Higher interest expense means lower profits. Lower profits means layoffs and reduced investment. And for weak companies, it means default risk. Default risk widening is what people mean when they say credit spreads blowing out. Pressure point number 4, the government's interest expense narrative. This one gets people emotional, so let's be precise. The U.S. government can pay in nominal terms. But as more debt rolls over into higher rates, interest expense becomes a bigger line item. Markets then start paying attention to auctions, demand, foreign buyers, and fiscal policy. This doesn't automatically mean default. It can mean higher yields are required to attract buyers, especially if inflation credibility gets questioned. Pressure point number 5, the everything bubble hangover. When rates were near zero, money was basically free. That era rewarded growth at any price. Meme stocks, zero-profit tech, crypto hype cycles, you name it. But when rates rise, the math changes. Future cash flows get discounted more. Valuations compress. And this is where people feel like something is collapsing, even if it's really just prices returning to Earth's atmosphere. Now, how does this connect back to Goldman and the $847 billion number? If you're Goldman and you see bond volatility, liquidity, stress, refinancing risk, and potential credit events, you do what institutions always do. You reduce exposures that can trap you. You increase liquidity. You hedge scenarios. You prepare for forced selling events where you can either get hurt or be the buyer. That's the core idea. This isn't just about being bearish. It's about being positioned to survive a regime shift. Before we get to practical advice, we need to talk about one more thing. People hear bonds are selling off and assume that means stocks are next. Sometimes yes, sometimes no. So let's connect bonds to your portfolio in a way that's actually actionable. Transition 1 intro gives segment 1. Let us start by translating that scary $847 billion number into what it actually means in the real financial world. Transition to segment 1 gives segment 2. Now that we've cleared up the headline math, let us talk about why the bond market is acting like it drank 3 energy drinks and read the CPI report at the same time. Transition 3, segment 2 gives segment 3. Okay, so the bond market's under pressure? The next question is, what do giants like Goldman do when the foundation starts shaking? Transition for segment 3 gives segment 4. And if you think this is unprecedented, I've got a historical story for you that sounds old, but feels way too familiar. Transition 5, segment 4, gives segment 5. So history rhymes. Now let us talk about where the rhyme turns into real damage, what actually breaks when yields stay high. Let's bring it home. Goldman sold $847 billion in U.S. bonds. Headline is shocking on purpose. But whether that number reflects Goldman's own positioning, their client flow, or dealer activity, the underlying message is still important. The bond market is not in a sleepy, stable era anymore. It's in a regime where rates, inflation, expectations, deficits, and liquidity conditions can change fast, and fast changes break leveraged assumptions. Big institutions don't wait for confirmation. They reposition for scenarios, higher for longer, recession, and credit stress, or inflation reacceleration. And the surprising historical connection, like the 1994 Bond Massacre, reminds us that bond turmoil docentee stayed trapped in bondland. It spills into housing, jobs, banks, and stock valuations. So no, this isn't guaranteed doom. But yes, this is a very real signal that the people closest to the plumbing are taking risks seriously. If you want more videos that translate Wall Street headlines into normal human language, hit subscribe. And share this with that friend who says bonds are boring, because right now bonds are basically the main character. Also comment rates if you want to follow up on what happens next. Recession, soft landing, or round 2 of inflation.